When we analyzed the full-year results for 2025, we called the Initiates Plc one of the strongest companies we'd analyzed on this channel. Not because it posted spectacular growth, but because that growth was backed by real cash, a stronger balance sheet, rising shareholder value, and remarkably clean financial reporting. In that analysis, we also left you with 3 questions. Could this extraordinary growth continue? Would the large investment in new assets actually pay off? And would cash generation remain as strong as the accounting profits? Today, we will see that the Q1 result answers almost every one of those questions. Some concerns have disappeared, one has become even bigger, and one entirely new trend has emerged that investors shouldn't ignore. Let's go behind the numbers. Welcome back to Behind the Numbers TV, the channel that breaks down financial statements in plain English. No finance degree required. Today, we're looking at the Initiates PLC's unaudited first quarter 2026 results. If you haven't watched our full analysis of the company's audited 2025 financial statements, I'd recommend watching that after this video, because today's report isn't the beginning of the story, it's the next chapter. Instead of asking whether this is a good business, today's question is much simpler. Has the investment case become stronger or weaker? Let's find out. In the last video, the biggest question hanging over the Initiates wasn't whether it had grown, it was whether that growth was sustainable. After all, revenue had surged by more than 150% during 2025. For an established company, that's unusually fast. Investors naturally wondered whether the business had genuinely entered a new phase of growth, or whether one exceptional year had simply flattered the numbers. The first quarter results provide the strongest answer we could have hoped for. Revenue didn't slow down. In the first quarter of 2026, revenue rose to 3.57 billion naira, up from 1.2 billion in the same quarter last year, growth of almost 197%. That's not a repeat of last year's pace. That's faster. Even more impressive, profit grew even faster than revenue. 1.13 billion naira this quarter, up from 312 million a year earlier, growth of over 260%. That shows the business isn't simply becoming bigger, it's becoming more profitable as it grows. That's the exact opposite of what investors usually fear after explosive growth. An important detail is that profit grew faster than revenue. That's a sign the business didn't sacrifice profitability to achieve this growth. In fact, its margins actually improved. Gross margin moved up from just over 51% to just over 31%. In our last video, we questioned whether the exceptional growth reported for 2025 could be repeated. Based on these first quarter numbers, that concern has largely been answered. The 2025 result wasn't a one-off. The growth engine is still running, and if anything, it's running hotter. But rapid growth often creates a new question. Can the company still convert those accounting profits into real cash? That's where the story becomes more nuanced. Whenever a growth rate accelerates this fast, the instinct should be the same one we used last time. Check the cash. Here's where this quarter gets more complicated than the full year did. Operating cash flow this quarter came in at just over 1 billion naira. Compare it to this quarter's profit of 1.13 billion, and for the first time, cash generated is actually a little less than profit reported. To put that in context, for the full year 2025, this company generated 141 naira of cash for every 100 naira of profit. This quarter, it generated closer to 90 naira of cash for every 100 naira of accounting profit. Now, before anyone panics, this isn't necessarily bad. Generating 90 naira of cash for every 100 naira of profit is still perfectly respectable. The important point is that the relationship between profit and cash has changed. So naturally, the next question becomes, why? The balance sheet provides the answer. One number immediately stands out: trade receivables. This is money customers owe the company for work that has already been completed. The company has recognized the revenue. The profit has been recorded, but the cash hasn't arrived yet. By the end of the first quarter, Trade receivables had grown to more than 8.18 billion naira. That's over 60% of the company's total assets. In plain terms, the business is expanding so quickly that sales are arriving faster than the cash from those sales is landing in the bank. For companies experiencing rapid growth, that's not unusual. Winning larger contracts often means waiting longer to be paid. However, it is something investors should keep watching, because if it keeps building without customers actually paying it down, today's soft cash conversion could turn into tomorrow's real cash problem. On the flip side, if they are paid over the coming quarters, the temporary gap between profit and cash should narrow again. So, has the cash story changed? Yes, but not in the way many investors might expect. The company is still generating positive operating cash flow. It is still producing real cash from its operations. The difference is that rapid growth is now putting more pressure on working capital than it did during 2025. At this stage, that looks more like a consequence of success than a warning sign. But the next quarter will tell us whether this is simply the cost of growing quickly or the beginning of a longer-term collection problem. And while cash generation became slightly less impressive, another part of the business became even more ambitious. Management dramatically increased its investment in new assets. That investment could become one of the biggest drivers of future growth, or one of the biggest disappointments. That's where we turn next. In our last video, we highlighted one item on the balance sheet that deserved closer attention, a line called Asset in Transit. At the time, it had increased almost sixfold during 2025. We didn't treat it as a red flag, but we did ask an important question. What exactly is the company buying, and when will those assets begin generating revenue? The first quarter results tell us one thing immediately. Management hasn't slowed down. They've accelerated. In just the first 3 months of 2026, the company committed more than 2.1 billion naira to assets still waiting to be delivered, installed, or commissioned. That's more than twice what the company invested in asset in transit during the whole of 2025. Even more striking, when we include spending on new property, plant, and equipment, total investment during this single quarter reached roughly 2.3 billion naira. That's already more than the company invested during the entire previous financial year. This tells us something important. The large asset in transit balance we questioned last year wasn't simply a timing issue. It's now clearly part of a much larger expansion program, and that changes the conversation. The question is no longer whether the company is investing. It clearly is. The question now is whether those investments are already producing the remarkable revenue growth we're seeing today, or whether the biggest benefits are still to come. That's a question these financial statements can't fully answer, but there is one encouraging clue. Revenue didn't merely continue growing, it accelerated to almost 197% year on year. That doesn't prove the new assets are already contributing, but it does suggest management isn't investing into a stagnant business. They're expanding capacity while demand continues to grow rapidly. So for now, the investment program appears consistent with the company's operating performance. Still, this is one area investors should continue following closely. If these assets begin generating additional revenue over the next few quarters, today's heavy investment could prove to have been well-timed. If they remain on the balance sheet without contributing meaningfully to growth, then the investment story becomes much less compelling. Fortunately, while management was investing aggressively for the future, they weren't financing that expansion by piling on debt. Another question we raised in our previous analysis concerned management itself. Both the chairman and the managing director had trimmed their personal holdings during 2025. This quarterly filing simply doesn't include updated ownership disclosures, so there's nothing new to report here either way. So, unlike the other questions we've been able to answer today, this one remains unanswered. We'll revisit it when the next annual report is released. With that, let's step back and look at the overall financial position. Rapid growth only creates lasting value if the balance sheet keeps pace. Otherwise, today's success can become tomorrow's financial strain. For the Initiates, the first quarter results suggest the opposite is happening. The company's financial position continued to strengthen. In just 3 months, total assets increased by more than 15%. Net assets, the value that ultimately belongs to shareholders, grew even faster, rising almost 20%. And importantly, none of this came from issuing new shares. Just as we saw in the annual report, shareholders weren't diluted. The business simply became more valuable. Liquidity also improved. The current ratio increased from 1.43 times at year-end to 1.70 times. Simply put, the company now has more money and assets available to pay its short-term bills. That's a reassuring sign for a business expanding this quickly. Another encouraging trend continued quietly in the background. Debt kept falling. Long-term borrowings dropped from about 700 million naira down to just 98 million. That means management is doing something many fast-growing companies struggle to achieve. They're expanding the business without accumulating new debt. Which brings us to the question every investor eventually asks. The business looks stronger. The balance sheet looks stronger. But has the market already recognized all of that? Or is the stock still attractively priced today? In the last video, we concluded that the Initiates looked attractively valued. The business was growing rapidly, generating real cash, strengthening its balance sheet, and doing all of it without diluting shareholders. So the obvious question now is this: has another exceptional quarter pushed the stock beyond fair value? Surprisingly, the answer still appears to be no. Let's begin with earnings. As a quick reminder, the price-to-earnings ratio simply tells you how many years of current profit it would take, at today's rate, to earn back the price you paid for a share. The lower the number, the less demanding the price looks relative to profit. At the current share price of 30 naira, investors are paying somewhere between 6 and 8 times earnings, depending on which earnings measure you use. Using last year's full audited profit, this stock trades at just under 8 times earnings. Using a blended figure that replaces last year's first quarter earnings with this year's much stronger first quarter, that multiple falls to around 6.4 times. And if you simply multiplied this quarter's profit by 4 to estimate the whole year's earnings, a shortcut investors call annualizing, the valuation would look even cheaper, at just under 6 times earnings. But here's why we shouldn't rely too heavily on that number. Last year, the first quarter contributed only about 9% of the company's total annual earnings. Most of its profit came much later in the year. So annualizing this quarter is useful for illustration, but it isn't a reliable forecast of what the company will earn over the full year. Whichever method you choose, the conclusion is broadly the same. This remains a single-digit price-to-earnings multiple. For a company that has now delivered almost 197% revenue growth, 261% profit growth, expanding margins, improving liquidity, falling debt, and no shareholder dilution, that's a surprisingly modest valuation. But earnings are only half the story. The market is also paying a premium above the company's book value. A quick reminder, book value is roughly what would be left for shareholders if the company sold everything it owns and paid off every debt it owes. Book value per share has now increased to roughly 7.75 naira. At a share price of 30 naira, investors are paying about 3.9 times that book value. At first glance, that sounds expensive, but the important point is how that premium was created. The company increased its book value by consistently generating profits and retaining a large portion of those earnings inside the business. That's a much healthier foundation for paying a premium. Of course, no valuation exists in isolation. The market may still be applying a discount because investors want proof that this extraordinary growth can continue throughout the rest of the year. And that's perfectly reasonable. One exceptional quarter doesn't eliminate every uncertainty. The next 2 quarterly reports will be just as important. They'll tell us whether this remarkable pace of growth can be maintained. So, is the Initiates still worth buying at 30 naira? Based on everything we've seen today, the investment case hasn't weakened. If anything, it has become stronger. So, does the sequel live up to the original? Mostly, yes. Not because every number improved, but because the overall investment thesis continues to strengthen. The questions we raised after the annual report have largely been answered. Revenue growth accelerated. Margin compression, one of the smaller concerns from last time, has reversed entirely. But this quarter also introduced something genuinely new to watch. Cash conversion softened for the first time, and it's tied directly to a growing pile of money still owed by customers. That's not a crisis. It's a new question that didn't exist 3 months ago. That's something we'll continue monitoring over the coming quarters. But based on the evidence available today, it isn't large enough to outweigh the company's many strengths. For new investors, accumulate. At around 30 Naira per share, the Initiates still trades on a valuation that appears attractive relative to its growth, profitability, balance sheet quality, and shareholder value creation. The key condition is that Q2 and Q3 confirm this growth rate holds, and that the receivables build doesn't turn into a genuine collection problem. For existing shareholders, hold. The case has gotten stronger, not weaker, since our last video, and if anything, this quarter gives you more reason for confidence than concern. Continue monitoring receivables, cash conversion, and the progress of the asset in transit program. But based on today's evidence, the company's long-term direction remains encouraging. That's it for the Initiates PLC's unaudited first quarter 2026 financial results. If there's one thing to remember from today's analysis, it's this. The best investments don't just deliver strong numbers once. They keep proving the original investment thesis right, quarter after quarter. For the Initiates, this first quarter didn't just continue the story we saw in the annual report, it strengthened it. Before we wrap this up, remember, this video is not financial advice. It is for educational purposes only. Always do your own research or consult a licensed financial advisor before making investment decisions. Now I'd like to hear from you. Has this quarter increased your confidence in the Initiates PLC, or are the rising receivables enough to make you cautious? Let me know in the comments below. If you enjoy evidence-based investing without the hype, like this video and subscribe to Behind the Numbers TV. Also, turn on notifications so you never miss our next deep dive into the Nigerian stock market. Because every number tells a story, and together, we'll learn how to read it. See you in the next video. Thanks for watching.